and welcome to another edition of Trust Issues by Kepler Trust Intelligence. In this podcast, we speak to leading investment trust managers about the philosophy behind their strategies and the themes that are shaping their portfolios. Today, I'm joined by Ayush Abhijeet, an investment director at WhiteOak Capital Partners, the investment advisor to Ashoka India Equity, which has the ticker AIE. AIE is a sector-leading Indian equity investment trust that was launched in 2018, during which time it has delivered a net asset value total return of 144% versus its average sector peer, which has delivered an average NAV total return of around 50%. AIE looks to capture the best growth opportunities at reasonable valuations from India, with a bias towards small and mid-cap companies. Management has certainly demonstrated their ability to generate alpha from the asset class, as you can see in the performance figures I quoted just now. Now, Ayush is responsible for covering the technology, consumer discretionary, and metals sectors at WhiteOak. He joined the company in 2017 and has more than 10 years' experience in investment management, equity, and macro research. Ayush, thanks for joining me today.
Thanks, David. Pleasure.
Now, it's hard to start anywhere other than the performance of the Indian equity market. Obviously, in the context of emerging markets really kind of outperforming strongly. We've seen some weakness in India in particular in recent months. And the country hasn't really kind of participated in that upswing that we've seen. What factors are at play in your view here?
So we've certainly seen a very big divergence between the performance of India versus other emerging markets. In fact, this is probably the biggest divergence if you kind of look at the last 15 to 18 months. The spread, surprisingly, is just about 40 to 50%. That's how much GEM as an asset class has outperformed India, which is quite staggering. And I think there are multiple elements at play here. Firstly, prior to this pullback in India, we have to keep in mind that there was a four and a half year rally that the markets had seen. So right from 2020 till 2024, there was a big bull market that played out. And typically, you do see some bit of healthy correction, healthy pullback in any market that sees a blistering rally like that. So that is the starting point. Secondly, I think earnings growth in India have been a bit patchy, and there's been some bit of disappointment around that. The long-term earnings growth in India, and when I say long-term, over the last 30 years, the long-term earnings trajectory has been in the ballpark of 12% per year in local currency terms and about 8% in US dollar terms. Now, in comparison to this long range 12% earnings growth, the last year and a half have ended up at mid to high single digits. So that has been a bit of a disappointment. In particular, pockets like consumption, a little bit on financial services, their earnings has been rather weak. And number three, what we've seen is a rotation out of India into other EMs like China, Korea, Taiwan, Brazil. Markets like Korea and Taiwan have benefited tremendously from their presence in the artificial intelligence semiconductor value chain. Even economies like Brazil and South Africa that are very commodity oriented have benefited from the rise in prices of these commodities. So India, in a way, has been the market where we have seen many managers book profits and use it as a funding source to reallocate to other emerging markets.
Yeah, I guess that kind of dynamic does seem to be playing out across the world, I suppose. You're seeing some cash come out of the US and, everywhere else is outperforming. So, clearly it's kind of seems to be a rational kind of follow on from that. I guess one interesting development that we have seen is selling to the tune of $3.4 billion from international investors in India. But that slack was taken up by $7.6 billion of net buying from domestic institutional investors. So, quite a divergence there. why are these dynamics playing out and what do they mean?
So let me zoom out and first talk about the ownership construct of the Indian markets for our listeners. So when you view the stock ownership of India, there are four key components. The biggest one is the controlling shareholders, the founding families. They own just about 50% of the stock market. The next two constituencies are what you described: the foreign institutional investors and the domestic institutions. They own approximately 17% each, maybe 17 to 18, keeps moving, but call it 17 to 18% each. Right? And then the fourth constituency is direct ownership through retail, high net worth individuals, etc. Right? Now, these two, the foreign institutions and the domestic institutions, they again have seen divergent trends in terms of flows. On one hand, we have seen foreign institutions not really being net buyers in India over the last, I think, 5, 6 years now. In fact, cumulative, if you add the last 5, 6 years of foreign flows, it's been, I guess, marginally negative. And then on the other hand, domestic institutions have become a bigger and bigger part of the overall flows into the markets. See, typically when economies grow, you do see the emergence of domestic asset management industry. In India, we've seen precisely that. In fact, India has seen a big inflection in equity participation from households, from the common man. Historically, bulk of the household savings were tied in gold and real estate. These are the two major components of household wealth. With the advent of smartphones, with ultra cheap internet, um, there's been a big change in awareness and democratization of access to financial products, to mutual funds. And this awareness and democratization have led to a very big participation from households, right? And they ultimately flow channel their savings into mutual funds, apart from direct ownership. So we have seen $50 billion per year of domestic flows into equity markets on the back of what is called systematic investment plans, SIPs, which are very granular monthly contracted flows into equity funds to the tune of 3 billion per month, which is $36 billion per year. Right. So we think it is a decadal, multi-decadal trend that we're witnessing. And it is great to see that uh, the markets are not dependent on one single constituency, which 20 years ago, if you were having this discussion, uh, foreign institutions used to be a disproportionate size of flows. And that kind of has changed for the good. It's very healthy for the long-term trajectory of Indian markets.
Yeah, I think sitting from here in the UK, we're having this exact conversation. I think, we need more ordinary people to start kind of buying into the equity story and, build a real investment culture. So it's great to see that, India are already kind of on that journey as well. So how have management been navigating this tricky period? Are you seeing any kind of value emerging at all?
I think it's a stock picker's market today. Um, the pullback in the last year and a half, markets peaked somewhere around September of 2024. So it's been more than a year and a half now. And the pullback has been quite severe in certain pockets of the market. Right. So while headline indices have pulled back, small, mid-sized companies have been beaten down quite a bit. In fact, the median pullback in smaller companies is to the tune of 30 to 40%. It is a meaningful pullback. And what that means is there are a lot of attractive opportunities that are now emerging for stock pickers. And what we've done is, as you know, at Ashoka, we have a very big, experienced, on the ground investment team. 35 research analysts present on the ground in India, conducting extensive due diligence. That entails more than 3,000 meetings every year. They're up and about, they're visiting factories, they're talking to management teams, they're talking to competition, talking to industry analysts, regulators, and trying to create a very differentiated view on businesses, right? And that becomes the core of our value proposition in the Ashoka Investment Trust. So we are seeing a lot of value emerge in pockets, certain areas like even in larger companies. If you look at financial services, in our portfolio, private sector banks, well-run private sector banks, have been a mainstay of our financial services exposure since we launched the trust, and we have seen significant amount of value emerge in that segment. Just to take an example, even though we all are always relative value investors, uh, and then I think, unlike 2020 to 2024, where you could just throw a dart and the company that you picked probably did well, today the dynamic is very different. And in fact, it's good for these are precisely the times when you find your best ideas, and you're able to buy them at very attractive valuation, which sets the stage for future 3, 5, 10-year returns. So we are actually quite excited to go hunting in a market like this.
Yeah, and you kind of talked about that, big experience on the ground investment team that you guys have. I mean, how much of a benefit is that for AIE versus peers?
I think it has to be our biggest differentiator and our competitive advantage compared to our peers. It's rare for investment trusts and even for other competing open-ended vehicles to have such a deep team which is on the ground. Um, the Indian equity markets are very fragmented and heterogeneous. And let me explain. US has about 4,000 odd listed stocks, right? And US would be a 60, $70 trillion market. India is in the ballpark of $4.5 trillion. And India has several thousand listed stocks. It may be by some counts 5,000 stocks. And within that, our investment universe is about 1,000 stocks because we go very deep into small and mid-sized companies that are under-researched, under-brokered. You can't just log into a sell-side equity research platform and read a report off the shelf and get a financial model off the shelf. You have to do everything bottom up. There's a lot of primary research that is entailed, right? And that's what our on-the-ground team is doing day in and day out, conducting primary research. Right? And our coverage universe is also very wide. We cover more number of companies than any other peer, um, because of the depth of the team that we have. So in a market environment like this, where there's such a big correction in the mid and small size segment in the market, I think it is fertile grounds for alpha extraction as we speak.
Yeah, and I guess you guys also, not just the listed companies, you guys can do like pre-IPO stuff as well. So, that firstly obviously brings even more companies into your kind of your realm, but also gives you even more of a kind of USP because, again, you can't get these broker reports and everything from unlisted companies. You really have to kind of go down and do that due diligence.
Absolutely, David. So since the very beginning, which is 2018, we have had roughly 10% uh, allocation to, or rather 10% budget to pre-listing companies or the pre-IPO segment. And our sweet spot tends to be companies that have a very clear line of sight to doing an IPO, going public in the next, call it, year and a half. And that's the sweet spot for us. Um, this segment also tends to be very inefficient, just like the small and mid-sized segment, even a lot more inefficient because very few companies can participate at this stage. It is probably too late for traditional private equity investors, and most of the public markets only investors don't have the mandate to cross over into the private side. And therefore, very inefficient, and very few specialized companies like us participate in that market. Since 2018 till now, this pre-IPO segment has been a big contributor to overall alpha in the firm, and the board have allowed us to increase the mandate now to about 15%. Given the growing size of IPOs, even though equity markets have not done well in the last year and a half in India, the IPO market has been very buoyant. We've had in the ballpark of 200 initial public offerings. Just to put that in context, probably the most active IPO market in any large economy today. And within that, we are constantly trying to pick opportunities. Um, and another important aspect, which often gets overlooked, is how this pre-IPO investing helps us in our public markets portfolio, which is bulk of 90% of our portfolio. See, many of these companies, we start interacting with them a couple of years before they become public, and therefore we've analyzed these companies. We have met the management team, interacted with them multiple times before they go public. Most of our peers meet these companies for the first time, maybe a couple of months before the IPO, right? And that allows us to have a differentiated view on the quality of business and the management team and the economics of the business compared to our peers once these companies are listed. Right? So this the focus on small and mid companies and this sleeve of uh, low double digits in pre-IPO opportunities become the big kind of alpha generators within the trust's portfolio.
So it's really great to hear that, despite challenging markets at the moment, those IPOs are still coming through, because I think a lot of the time, you see companies kind of retrench and kind of look to delay plans if markets are going through a rocky period. So it's, great that, that's still kind of coming together. And looking forward, I mean, what do you see as kind of the potential drivers of an eventual re-rating of the Indian equity market?
So I think that the Indian equity markets have been an earnings growth driven story for the last 3 decades. Right? Contrary to popular perception that it is a very expensive market and therefore a lot of the returns would have come from multiple expansion. So India is an earnings growth story. Um, and earnings growth have been disappointing in the last couple of years and the markets have not done well. Going forward, our base case expectation, David, would be that market should track about 10 to 11% in local currency terms, and which is about 7 to 8% in dollar terms, in line with the nominal GDP growth rate and the real GDP growth rate, right? So the economic engine continues to chug along really well. The latest GDP growth print was 7.5% in real terms. So the real economy continues to do really well. Then the macro setup is also fairly benign. Inflation, interest rates, things are looking very good. There is 5.25 percentage point of rates, and the inflation forward-looking expectation is about 3.5–4%. Right, so there's a big spread between interest rates and inflation. So ample room for the central bank to cut rates as and when necessary to supercharge the economy. From a fiscal balance perspective, uh, credit where it's due. This government has done a terrific job in terms of fiscal discipline. So fiscal deficits have continue to trend down over several years. And this GDP growth of 7.5% has come despite this headwind of fiscal consolidation, mind you. And then even on the current account side, barring the disruption in oil prices that we've seen over the last few weeks, uh, the government has done a good job in terms of managing the current account balance of the last few years. So from a macro setup today, things look benign. Valuations have come off below the last decadal average. So starting point from today would be below the average valuation of the last 10 years. And the macro setup looks good. Earnings expectation over the next 12 months, the consensus is building low to mid teens, We might see some cuts because of the Iran crisis, but even if we were to see double-digit earnings growth, that in itself should be a catalyst for broader markets.
Sure, and I suppose we've touched on a few of these kind of these key points previously, but it's worth kind of reiterating them. I think. Why do you think AIE is kind of well placed to capitalize on these opportunities?
Apart from the depth of the investment team, on the ground presence, what we focus on is companies that have three key attributes. Number one, they should have the ability to deliver high returns on capital, much over the cost of capital, which in turn is a function of their core competitive advantage. We spend a lot of time thinking about competitive advantage and the durability, longevity of this competitive advantage. The second attribute that we look for is scalability. India is a growth market. We want to buy companies that can scale, that can be 2, 3, 5, 10 times bigger than what they are today over the coming years and decades. And the third thing that we look for is outstanding management teams, outstanding entrepreneurs, strong track record of execution while adhering to good corporate governance standards. And we think that our team is well equipped to have differentiated insights into all of these three metrics. And then finally, we follow a proprietary valuation framework, completely shun traditional price to earnings, EV/EBITDA like metrics. We think these accounting metrics can be very distorted, misleading, even harmful if blindly used for investment decision making. And we instead focus a lot more on economic cash flows over and above the cost of capital. And that again becomes the primary input around our value framework, relative value framework. So I think a combination of these two should allow us to find outstanding opportunities in the Indian markets, as we have done over the last uh, 7, 8 years now in the trust.
Yep. And you kind of mentioned in passing Opco Finco, which is that kind of proprietary in-house valuation model that you guys use. Be good to just kind of touch on that briefly in terms of kind of how it helps you guys hone in on these opportunities.
Now, absolutely. So the economic cash flow centric framework, which I mentioned, um, at the heart of this is breaking down the value of a company into two components. One, that houses a lot of the financial assets, which is your plant, property, equipment, machinery, working capital. So all the capital investments deployed is housed in one entity, and then all the operating assets, the operating business is housed in another entity. And then um, we value these two parts of the business separately, as opposed to calculating and accounting earnings and slapping a price to earnings multiple and saying this is the value of the company. We value these two components separately, and that allows, to our minds, a more apples to apples comparison, not only within companies in an industry, but also across industries. Um, and the metric, which is price to economic cash flow, which we focus on, normalizes for the lot of distortions that sit in accounting multiples, like variations because of distortion in capex intensity, variations in working capital profile, different capital structure decisions that, let's say, a CFO takes on the balance sheet. So it normalizes for all of this. And therefore, I think we can come to superior decisions around value as opposed to just looking at a price to earnings multiple and saying that this is cheap or this is expensive.
And how does AIE balance running what is a very high active share portfolio with keeping risk under control through diversification?
So, one of the core tenets of our investing style has been that we do not take disproportionate risk in one single security. We try to run a large number of names in the portfolio, have always had. And this allows us to invest in a lot of small and mid sized companies, which we otherwise would not be able to do if we were to handcuff ourselves with artificial constraints like running a 20 stock or a 30 stock portfolio. Right? Because many of these small and mid sized companies would just not be investable. Uh, And it also allows us to ensure that we do not take liquidity risk um, more than what is warranted. You always take liquidity risk when you invest in a stock. And the teams also take in decisions very independently. So we run a team of sector experts. So for every sector, there's a team of 3 to 5 professionals that specialize in a sector. And this becomes the primary decision-making unit that is picking stocks in their particular portfolio. Right. So in a way, imagine a 4-member healthcare team that is picking 15 stocks in healthcare, totaling up to 10%. So roughly 60 or 70 basis points position on average in a healthcare sector. So this is how we're able to run a high active share, because a lot of these stocks may be off benchmark stocks, um, and at the same time not take undue liquidity risk by restricting the maximum exposure that we can take to a mid small cap company, which tends to be probably a 1%, 2% kind of a on average exposure in a single name.
Sure, Ayush, that was a great run through. Hopefully, some some real positives. Obviously, it's a difficult time at the moment, but I guess that kind of happens. You know, it's a healthy kind of a healthy kind of thing that happens in stock markets. Hopefully, some good news to look forward to. Thanks for joining me today.
Thank you, David. And if you look back at, if you were to ask me, what are the 2 best opportunities to buy India in the last 5 years? They were, number 1, at the depth of the COVID crisis in March of 2020. And the second best time to buy was in 2022 when the Russia-Ukraine war broke out. Right? And then a few years later, we'd also think about what was the third best time to buy the stock market in the last 5 years. And it very well might be the Iran crisis.
Yep, it's a great time to end. Now, if listeners do want to find out more about AIE, they can visit the Kepler Trust Intelligence website. We've got research notes there, we've got results analysis and some feature advertorials, and obviously do visit the AIE website as well, which we'll link to in the description. Thanks for listening today, and we hope to see you soon. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It's strongly recommended that if you're a private investor, independent financial advice should be taken before making any investment financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.